Hello and welcome back to All Things Money. I'm your host, David Blain. During this segment, we're going to continue our discussion about some recent findings that were published in the Wall Street Journal. This was on September the 20th under the Intelligent Investor column. Analysis of the CFPs listed on the CFP's website and as it relates to the term fee only. Now, according to the CFP board itself, as well as securities lawyers, if a advisor works for a firm that charges commissions, then that advisor should not use the term fee only when referring to themselves. And what this research found, analyzing almost 34,000 profiles, was that many of the CFPs that work for Morgan Stanley, UBS, JP Morgan, Bank of America Merrill Lynch, LPL, Raymond James, Ameriprise, all these firms, the Wall Street Journal identified numerous advisors that work for those firms referring themselves as fee only. And of course they notified the CFP board, which was of course shocked to learn that there were CFPs out there holding themselves out as fee only when they weren't really. And they started contacting them and explaining to them that they had to change their profile and that they weren't fee only. But it's a big problem. As I've said before, there is so much money in this industry and so much at stake that there is a very sort of, a lot of people are willing to skirt the rules, and they're not all blatant, Bernie Madoff, but there's a lot of shading of the rules that goes on, and this is just another example of it. In fact, Jason Zweig, who wrote the article that I'm referring to, he went to the website of several of these advisors, and there's one in here. Go to the Wall Street Journal and read it. I don't want to pick on this one guy, but there's a guy out there. He's an investment advisor in Medina, Pennsylvania, and his website says, quote, this XYZ advisor is a fee-only financial planning firm. Fee-only planners like us are compensated solely by fees paid for their clients and do not accept commissions or compensation from any other source. We do not earn any money from commissions, trailers, or markups. Okay, this is what the guy's website says. However, if you go to their Form ADV, which is the legal document required to be filed with the Securities and Exchange Commission, it says that, quote, Mr. XYZ may receive a usual and customary commission for selling investment products and normal commissions for selling insurance. Mr. XYZ readily admitted to me, not me, but the person writing this article for the Wall Street Journal, that he earns commissions. The language on his site, this person said, was provided automatically by his website designer as it intended to only explain the characteristics of a fee-only financial planning firm. Quote, that doesn't mean I am those things, it means that's what those things are. Now to me that sounds like quibbling over the definition of is, if those of you know what I'm talking about. I mean, that's just absolutely ridiculous. I mean, here's a guy that's caught red-handed on his website talking about fee only and how he's fee only and this is firm and everything. And in his own public disclosure document filing with the SEC, it admits that he charges commissions. And then he has some half-baked explanation. So this is the stuff you got to watch out for as the investing public. And this is why there's a big debate going on under the Dodd-Frank reform about the uniform adoption of a fiduciary standard at brokerage firms. And this is why this will have almost zero impact on the industry whatsoever, and why I don't think it's a good idea, is people, for expediency and marketing purposes, they're going to continue to operate as they have and try to deceive the public. Of course, I am biased, but I recommend if you're looking for an advisor, go to the NAPFA website. We're not all perfect. There are NAPFA members who have gotten into trouble doing things, but generally what you're going to find is at least there you're going to know that the people are truly compensated by fee only. Anyway, it's an interesting debate as I've been talking about. The fee only term has been really co-opted and sort of bastardized over the years by the rest of the industry. And you see that all the time. Anytime there's a good thing going, you can be almost guaranteed that, you know, the larger firms and a lot of the people will just sort of ruin it for the rest of everyone. Okay. Many of you know I sit on the board of a large medical health care system here in eastern North Carolina, as well as I sit on the finance committee of West Point. And those type of large organizations tend to have private equity and venture capital and things like that in their portfolio. And at the individual investor level, you get a lot of questions about, you know, is this right for me in hedge funds and private equity? It's, you know, the investment du jour, and people want to get in. They see these big institutions doing it, which, by the way, I'm not a big fan of it even for institutions. It's not necessarily a proven method, a surefire method of increasing your returns. And I'm going to show you why. Some recent data that I've been looking at on the returns of private equity and venture capital are just not that encouraging for people. It's just like everyone else, or I'm sorry, every other investment is, people see good returns and so they start chasing those returns, and then the subsequent years don't turn out to be as good as the data they were looking at when they made that decision. Remember, past performance does not equal and is not an indication of future performance. I know you've seen that before, but it's true. We're coming up on the end of our second segment here. When we come back, we'll continue talking about the returns of private equity and venture capital.